Welcome back to the deep dive. Today we're diving into the Korean financial sector, and there's this real tension playing out, isn't there?
Oh, absolutely. It's probably the defining feature right now.
Yeah.
You've got this huge policy-backed push towards the future from the big players on one side.
Right, these massive strategic shifts.
Exactly. But then, on the other side, you've got some serious turbulence hitting the market right now. Think
Right.
regulatory questions, rising costs. It's creating instability.
So that's our focus, this collision. First, the huge strategic bets by groups like KB and Shinhan, basically trying to change how they lend money.
And second, the immediate fallout, the volatility shaking up things like insurance regulation and funding for capital companies. It's a lot to unpack.
It really is. I mean, we're talking about potentially the biggest state-aligned capital shift in years. When these giants pivot, they're changing everything, what they fund, how they fund it.
And crucially, their whole approach to risk.
Okay, let's start with that pivot. KB Financial and Shinhan Financial Group both making this identical, frankly staggering commitment.
Yeah, 110 trillion won each. That's what, over 80 billion US dollars over 5 years. All aimed at something called production and inclusive finance.
Production and inclusive finance. Okay, that sounds
Exactly what-
broad, almost like two different things mashed together. Can you break that down for us?
Well, they're meant to be complementary, but yeah, they are distinct. Production finance is the big strategic play funding high-growth industries. Future tech, critical infrastructure, think nation-building stuff.
And inclusive finance.
That's more the social side, helping out vulnerable groups, small businesses, maybe debt relief programs, kind of the safety net piece.
Got it. Let's look at KB first. There are 110 trillion, you said most of it, like 93 trillion is production finance. Where's that money actually going?
Right, 93 trillion production,
Oh.
17 trillion inclusive. And within that production chunk, the breakdown is interesting. 68 trillion is for loans, which is more traditional,
Okay.
but 25 trillion is pure investment. And this is where you see the real shift. 10 trillion of that goes into a national growth fund. And another 15 trillion comes from KB's own internal funds. They're not just lending here. They're taking direct stakes, acting like investors.
And the targets are ambitious, right? Not exactly safe bets.
Not at all. They're aiming squarely at the cutting edge. AI, semiconductors, bio, robotics, batteries, future cars, defense. They're explicitly looking for mega deals.
Mega deals sounds like venture capital talk almost.
It have that flavor. And importantly, they're trying to spread it out geographically, aligning with this national 5.33 regional growth plan. So not just dumping it all in Seoul.
You know, what strikes me even more is the internal change needed. If you're moving away from lending against buildings, you need new skill.
Exactly. That's why they set up this advanced strategic industry screening unit. It's an admission that their old credit checks won't cut it for, say, an AI startup.
Right.
The KB chairman even used the word destiny. He said converting to production finance is the destiny of all financial firms.
Destiny. Wow. That implies it's not really a choice anymore.
Pretty much. It's like move beyond basic retail lending or become irrelevant, even if it means taking on risks that would make traditional bankers nervous.
Okay, that's KB. Now, Shinhan matched the 110 trillion one. How are they differentiating themselves? Are they also chasing AI and mega deals?
Their production finance slice is similar, maybe 93 to 98 trillion, but their focus seems a bit broader. Yes, they're into the advanced tech too, but they also specifically call out energy transition, K-content, and K-food.
K-food, really? Alongside semiconductors and AI, does that feel a bit less strategic?
That's a fair question, Maybe Shinhan sees strategic growth a bit differently. Perhaps they view cultural exports or energy as equally important, maybe even less volatile than pure deep tech.
Interesting take.
And what's really notable with Shinhan is their infrastructure commitment. They've pledged 5 trillion won just for the support systems around semiconductor clusters, roads, water supply, the things that often bottleneck big projects.
That makes sense. You need the whole ecosystem.
Exactly. Plus, another 5 trillion for a regional high-speed rail project. They're investing around the companies, not just in them.
And like KB, they know they need new ways to manage this risk.
For sure. They set up a dedicated PMO, a project management office, just to track this stuff. The Shinhan chairman was very clear. They need better industrial analysis. They have to move beyond just looking at collateral.
So assessing the viability of a business plan, not just the value of its assets.
Precise. Can they actually figure out the risk of funding the future? That's the multi-billion-dollar question for both of them.
Okay, so that's the huge long-term vision. But like you said, that vision depends on stability now. And that brings us to the market friction, specifically this lot non-life insurance situation.
Yeah, this case really stirred things up. The financial regulator hit Lot on Life with a prompt corrective action, a PCA. That's a serious measure.
Okay.
But, and this is the crucial part, Lotte actually met the official solvency requirement, the KICS ratio. Theirs was 141.6%, well over the 130% guideline.
Wait, so they met the official target but still got sanctioned. How does that work? What was the reason given?
The regulator pointed to Lotte's very low basic KICS ratio. It was actually negative, minus 12.9%.
Okay, hang on. Basic KICS, what is that compared to the regular KICS, and why is it causing such a fuss?
Right, so KICS is the main solvency measure, the big health check for insurers.
Mm.
The basic KICS is like a stripped-down version. It deliberately excludes things like subordinated debt or hybrid bonds stuff companies issue to boost their numbers.
Ah, so it's meant to show the real core capital strength without the temporary props.
That's the idea. It shows the underlying unvarnished capital position.
Okay, I get the logic behind the metric itself, but if it's a useful metric, why is the industry upset about regulators using it here?
Because basic KICS isn't officially part of the rulebook. It's not ANA, not formally institutionalized as a trigger for sanctions like a PCA.
Ah, I see.
So the worry is, if you meet all the published rules, can you still get penalized based on a metric that isn't even formally adopted?
Yeah.
Where are the goalposts exactly?
That injects a huge amount of uncertainty, doesn't it? How can you plan billion-dollar strategies if the rules feel unpredictable?
That's precisely the fallout. You saw Korea Ratings immediately put Lotte Non-Life on review for a downgrade. Investor confidence takes a hit. And internally,
Yeah.
it pushes companies towards just trying to guess what regulators want rather than
Yeah.
sound planning. Sources called it eye service.
Eye serve it. Like constantly looking over your shoulder, spending energy, anticipating the regulator's mood instead of running the business.
Exactly. It's inefficient.
Yeah.
Instead of figuring out how to best deploy that 110 trillion won, you're worried about tripping over an unwritten rule. It encourages overly conservative behavior just to avoid trouble.
Which isn't great for driving growth.
Mm.
Okay, so that's regulatory friction. Now, let's talk about immediate financial pain, the rising cost of funding for capital companies, the OODO.
Yeah, this is hitting them hard right now.
Yeah.
They're caught in a pincer movement. You've got rising government bond yields pushing up borrowing costs generally.
The baseline cost of money is going up.
Right. And at the same time, there's a flood of new bonds being issued, especially by credit card companies, all competing for the same limited pool of investor cash.
And it's not just the smaller players feeling this, is it? Even the big bank-backed ones are struggling.
That's what the market data shows. Woori Financial Capital bonds, for example, were trading 0.1 to 0.14 percentage points higher than the average market rate, the Minpyong rate.
Can you explain that Minpyong rate? Why is trading above it a bad sign?
Think of the Minpyong rate as the benchmark price for high-quality corporate bonds. It's where solid companies should be able to borrow. When a company, especially a well-regarded one like Woori or Hana or KB Capital, who are also trading 0.1 points higher, has to offer more than that benchmark.
It means investors are demanding a bigger premium to lend them money.
Exactly. It signals weaker demand, tighter liquidity. Basically, they have to pay up to get the cash they need.
And this hurts capital companies more than regular banks, right? Why are they more vulnerable?
It boils down to their business model. Banks have customer deposits a relatively stable, cheap source of funds. Capital companies don't have that cushion.
Ah.
They rely heavily, almost entirely, on issuing bonds continuously to fund their operations. It's called refinancing, or shawan. They're constantly rolling over debt.
So if the cost of rolling over that debt jumps, even by 0.1%, it bites directly into their profits.
Immediately. And it limits their ability to operate, especially since their lending might be slightly riskier than a typical bank loan portfolio to begin with.
And this isn't a future problem. These higher rates are hitting them right as major debts come due.
That's the crunch. Companies like Hana, Woori, KB Capital, they all have big bond maturities hitting this month. They have to refinance now at these higher rates.
Which means less money available for new lending just when the government wants them pushing out more production finance.
It's a real squeeze, a direct contradiction between policy goals and market reality.
So let's pull these threads together. We have this massive, ambitious 110 trillion won strategic push for the future.
Driven by the top financial groups, aimed at transforming the economy. A necessary vision.
But colliding head-on with this immediate market mess, unpredictable regulations making planning difficult.
And soaring funding costs. putting direct pressure on balance sheets, especially for non-bank lenders.
It feels like the long-term strategy needs stable ground, but the ground itself is shaking.
That's the core tension. The success of funding AI or robotics hinges on being able to assess new kinds of risk accurately. But the whole system's stability is being undermined by things like regulatory ambiguity, which just adds more risk premium everywhere. These two forces, the strategic ambition and the market friction, are really going to shape the next few years.
Which leads us to a final thought for you, our listener. Thinking about KB and Shinhan pouring all this money into future industries, what really needs to change inside these firms? How do they need to rework their fundamental credit analysis, their risk models, to make sure this $80 billion bet actually fuels growth and doesn't just become a pile of bad loans they wouldn't have touched 5 years ago?
They need to rebuild the internal plumbing of finance to match the grand external vision. A huge task.
Definitely something to keep watching. Until next time, keep digging deeper. Estimated word count, 1,410 words.
Approx. 7 minutes, 50 seconds, 9 minutes, 24 seconds, based on 150, 180 WPM.